Vietnam entered 2025 with strong momentum, posting its highest first-quarter GDP growth in 5 years, 6.9% in Q1 2025, fueled by solid manufacturing activities and export, while inflation remained manageable at 3.1%. But momentum is now being tested by a new uncertainty. The Trump's proposed reciprocal tariff of 46% on Vietnamese goods. This has injected volatility into an already tense global trade environment. The situation remains fluid, but the impact on Vietnam is far less dramatic than the headlines suggest. We view the 46% tariff as unjustified and unlikely to materialize. It's not truly reciprocal. Harvard Business School estimates that only 16% of Vietnam's exports to the U.S. involve transshipment from China, and the trade surplus largely stems from U.S. and allied companies operating in Vietnam, including Apple, Nike, Intel, and Samsung. Diplomatic engagement is already underway. Vietnam has offered to increase imports from the U.S. and enhance transparency to address trade fraud concerns. At the same time, Vietnam holds strategic leverage. China demands respectful engagement before entering talks, and U.S. allies lack the capacity to replace Chinese exports. In this geopolitical deadlock, Vietnam's willingness to engage makes it a critical partner and improves its position at the negotiating table. Looking at Mexico, a country with a larger U.S. trade surplus and similar FDI dynamics, we believe a more realistic outcome for Vietnam is a tariff in the 20-30% range. Domestically, Vietnam is preparing countermeasures. Fiscal and monetary policies remain supportive, and stimulus is expected to help buffer external shocks. Under this scenario, we revise our 2025 GDP growth forecast from 7.4% pre-tariff to 6.3%, assuming a decline in export to the U.S. without accounting for potential offsetting gains in other markets. Vietnam is not just reacting to global trade uncertainty, it's adapting structurally. Since the Doi Moi reforms of 1986, exports have driven growth. But today, the country is shifting focus to infrastructure investment and domestic demand. Gross capital formation is only 31.7% of GDP, comparable to China in 1999, suggesting considerable headroom. The government is fast-tracking investment in roads, ports, and logistics infrastructure to lower logistics costs. Currently, it accounts for 17% of the GDP, much higher than the region. Lower logistic costs mean improving business profitability and stimulating household consumption. This is not merely risk mitigation, it's a strategic evolution of the growth model. The VN Index, the gauge of Vietnam's stock market, delivered a total return of 2.9% in USD in the first quarter. However, volatility heightened since the announcement of reciprocal tariff, as 80% of the daily trading volume is retail investors. As of today, the market has regained ground and is showing signs of stabilization, though still trading around 7% below its March level. But the underlying fundamentals are sound. Only 14% of listed firms are directly exposed to exports or FDI, while most are tied to domestic growth themes. And valuation? Simply put, it's compelling. The VN Index trades at a forward PE of just 9.9 times, near the lower band of its 5-year range. This creates a window for disciplined investors. With our stock-picking approach, we are selectively adding to positions in companies with strong balance sheets, stable cash flow, and limited exposure to the tariff narrative. While indirect risk persists, we believe they are largely priced in, and the upside is increasingly attractive. Overall, in an era of confusion, Vietnam faces headwinds, but it is not in crisis. Policy tools are active. Diplomacy is strategic. Structural reform is underway, and the equity market offers value for investors who can look beyond short-term noise. At TIM, we believe this is a moment not to retreat, but to lean in selectively with clarity and discipline.